And welcome back to the Right Mortgage Network Later Life Lending Insight podcast. It's me back with you today, Victoria Clark, Head of Equity Release at the network. Joining me on today's insight is the lovely Rachel Flanagan, National Sales Manager at More2life. Good morning, Rachel, and welcome to the podcast. Thank you for joining us today.
Morning, Victoria. It's lovely to be here. So thank you for inviting me.
Before we really get stuck into today's topic, let's start with how is the later life lending market? We're now in the 8th month of the year in 2024, so it is a great time for reflection. What are your thoughts on today's market then, please, Rachel?
I think the market has been a little bit slower than we would all have loved it to be. But what we are seeing in today's marketplace is that the demographic of customer is very much changing. So traditionally, what we've seen is customers who are sitting in their 70s and 80s. So the average age of customers hovered around age 71 for quite some time. Last year, that increased to age 72. And these are typically customers who've benefited from big house price growth over the last 40 to 50 years. They're not moving into retirement with any kind of debt that's sort of sitting with them at all. And they're generally sort of asset rich and cash poor. But what we're now seeing is an emerging different type of customer. So this emerging later life customer, and they're typically in their 50s and 60s. They've not had the benefit of the house price growth that the typical equity release customer perhaps has done. And what they're definitely doing is they're trying to balance their retirement planning with managing their existing property debt. They're still likely to be working and looking sort of to take their mortgage through into retirement. So we're definitely seeing a different shift of customer that's so very much out there as it sort of stands at the moment.
Yeah, and we know more2life brought into the market the exciting payment term lifetime mortgage product, which has been a part of the journey of what you're saying, of the step forward of change that we've been seeing, which is also with the affordability and managing total cost of borrowing. As discussed in some of our other podcasts, where we have also seen more and more partners addressing the changes, which is amazing, and obviously something that you guys got started in right at the start of the year. And then, Rachel, this brings me on to what I want us to go through as our next question. So we both agree assessing affordability really achieves a better bespoke outcome for customers. It's something we spoke about all year, and obviously more2life have got that embedded as they're thinking about the future. But why is it so important to be discussing affordability with our customers, and what should advisors be looking out for?
Great question. I think, we know that the FCA carried out a thematic review, and they did this over a 4-year period. And part of what came out of that review was there was almost too much reliance on equity release and a big lack of demonstration of really interpreting affordability for customers along the way. So it's been a highlighted spot, if you like, by the FCA. And I think when we've got advisors who are really sort of digging into a client's background, looking at their affordability, assessing their bank statements, what this will do is it hopefully leads to sort of better customer outcomes and also product suitability. So with the type of emerging later life customer that I've already described, what we're saying for these particular type of customers is that traditional product may not be the product that's right for them. It may well be that actually perhaps it's a RIO, it's a payment term lifetime mortgage, an interest reward type mortgage, that type of thing. But without that assessment of affordability, we're not actually going to get to that point. And from a lender's perspective as well, what we've got is, the more you're looking into that customer's circumstances, we're really being able to see, is this a right product for the customer? And actually, from when we're assessing their income, I think a lot of advisors sort of look at the bare basics of what they need to, but really need to sort of get into the nitty gritty of that affordability and, how much are they really spending in the supermarket? Because what they're telling us and actually what their bank statements show might be two different things. So, there are many things that we can look for, but what also can be shown, I think, when we're assessing affordability in a proper manner is also elements of vulnerability as well. So we have seen cases perhaps where things have cropped up on bank statements that have been a little bit unsavory. So that highlights the need, from the vulnerable customer sort of perspective. And, from a lending perspective, we have to be really careful that what we're not doing is we're not putting that customer into a situation that they're not going to be able to afford. So it really is taking everything, down to the nth level, a proper affordability assessment. And what that will get us down to is actually how much can that customer afford? And actually, can they make that as a committed payment? And if they can do that, and they can do that quite easily, that's great. That might take us down one route of product for that particular individual customer. However, if we know that actually some months that customer can afford a certain level of affordability and perhaps some they can't, then again, that could take us down to a different sort of route of product with the customer. So whether that be a voluntary payment, or an interest reward type payment for products that are out there, but actually, does it take us away from the committed payment element? And then you've got tools that are out there like the Air Navigator tool, where you're using a series of questions and thought process that will lead you from an advice perspective to the different options that might be right for that particular customer. So it's really vital that we dig into, everybody's ins and outs of what's going on in their sort of financial life, if you like, to get the right advice.
No, I completely agree. We've been saying, I think we've introduced getting bank statements for all of our customers so that they can really look at all the options available. And I just think, it's crazy if there's people still not looking at bank statements of customers. How are you really supposed to be able to assess the affordability and know what option is right for them? And like you say then as well, we've got the Air Navigator tool, which can really help people. So much is available now for people to be able to really look into the whole picture for all of our customers. And the more we can do to kind of get that out there with like you guys or the partners, things, it's just the wider industry. I know our network is doing it, but it's just getting more people to do it too. So yeah, it's great to have all of that on there. And then with Consumer Duty, I know that we thought this was no longer as much of a hot topic and not to be mentioned again. But it's actually a cool part of all of our businesses and always has been. And it is just really making sure our customers are being looked after, which is what all of this is about. It's not, beating people over the head with a stick about affordability and getting bank statements for the sake of getting bank statements. It's to really be able to look after your customer, like you say, vulnerability as well. You can really spot some things going on there that they may have never brought up. But since the implementation of Consumer Duty, controlling the cost of borrowing has been a big talking point. Has more2life as a lender seen an increase in voluntary payments, and how easy is this for the customer to make those payments?
So we definitely have sort of seen an increase in time, and we try and make it as easy as possible for the customer to make those voluntary payments. So they can either pick up the phone and they can give us their debit card details and make a payment over the phone as and when they want to, whether they want to do that once a month or a couple of times a year, they can do that. We get checks still that come in. The checks are drying up a little bit, I will say, but we still do checks on a monthly basis. And the other way is actually from a standing order point of view. And the great thing with that is that the customer has got the ability to stop and start that standing order as they see fit. So we don't control any of that at all. And I would say that having looked at the actual figures since Consumer Duty came in last year, then there's probably been an increase of about an additional 2,000 payments a month coming in from
Really? That's amazing.
and that's an additional amount. So we have definitely seen the uptake on that overpayment sort of really come into force, I think. And it's really important because you can really help with the total cost of borrowing from the customer sort of making those overpayments. And so I've got a case study here that I'd love to share with you. So this is a chap, 58 years old. He's got a house worth 285,000 and he's looking to release £77,805. Now, we're getting a lot of people that are coming to us at the moment who want the max borrowing because perhaps they've got that interest-only mortgage that they need to repay. So this is based on a max borrowing type of product. So it's naturally traveling with a slightly higher rate, so 8.6% MER. Now, obviously, he doesn't have to make any payments to us. It's a normal equity release loan. And his total cost of borrowing based over a 15-year period would be £281,352. Now,
Mm.
should he choose to make an overpayment, okay, so £244 a month he chooses to make every month, and let's say he does that for an 8-year period, that will actually reduce the total cost of borrowing down to £215,169. That's a massive difference to the estate. And what we're saying is, although we have a lot of people that come in who say, actually, my kids don't mind, they want us to spend the money, mum and dad have a nice life type thing. Mum and dad quite often still want to leave sort of something to the children. So it's a great way of controlling total cost of borrowing over the estate. However, if you have dug into the affordability of the customer, actually their ins and outs, their expenses, etc., then and you've determined that they've got the ability to make a mandatory payment, and we know that they can actually sort of see that through. If we translated that onto our flexi payment term lifetime mortgage, for example, because that travels with a much lower rate, 6.46% MER, their total cost of borrowing reduces again down from 281,352, where we started, to £161,537.
That is
That's
monumentally different. Oh my gosh.
massive. It's absolutely massive. So when we look at whether we're making a voluntary payment, whether we're making a mandatory payment, actually digging into affordability to help control the total cost of borrowing for the customers is really vital, I think, as we move forward. So, but definitely overpayments are definitely on the up.
No, and hearing things like that is just more, I think, what people have to get to know. If you've got the ability to make the payments, like just you can make them and it'll make a massive difference. And some really interesting insights that we've run through today on the podcast, which are really thought-provoking and shaping the future of lifetime mortgages. And I think it's exciting to see like how much more people can give the thought to this and really help their customers even more so if they've got the ability to do so. So Rachel, to round us off, where do you see the future of later life lending heading with all of this in mind so far that we've already achieved?
I think personally what we're going to see a reduction in age of customer because of the interest only crisis that we still face, and those different type of borrowers who are coming through. So I would anticipate that we'll see the average age of the customer start to drop as we move forward. But what I do think is there will be a lot of change in the marketplace. So I think there will be different approaches to advice. I think we have to see more holistic advice take place. We need to be thinking outside the box a little bit more going forward from those advice sort of perspective and needs of the customer. And I think what we will see is the development of many more products that are coming into the marketplace. And we've got a lot of development that's going on in the background that is really quite exciting, but I can't tell you too much about at the moment. So I'm dangling a bit of a carrot there.
Oh, exciting.
Indeed, it is really exciting. So I think we will see more product development. I think the market will evolve and it will change. And I think what we have to be able to do is, as lenders, to adapt to those needs of those customers as we see them sort of coming through. So, at the end of the day, we also need to build in for those people in the residential market or those people who are specializing in the later life space, perhaps working with those residential advisors. We need to see that joined up approach. We need to see more education earlier, I think, into the journey, the financial journey for that customer and their mortgage journey for that customer as they move through. But because later life, at the end of the day, it's not a last resort. Okay, this is a long-term plan and it's part of financial planning. But I think there'll be a lot of development that moves along with the market as this market moves forward.
Yeah, and watch this space. I think it's keeping us on our toes there, isn't it? We'll see what we've got next coming by the end of the year. But we completely agree with that too. We're really starting to promote that later life advisor, and we're actually giving them an accreditation for being that guy, basically, that man or woman who can offer the things to their customers, which is all product areas, but so for the over 50s, we're really getting the full review, and we want to promote this type of advisor. Hopefully that it will encourage more people to be that type of advisor as well, who you can take one customer and, like you say, put them on a journey and look after them for life, make sure they're set up properly, with everything to do with mortgages, RIOs, paying for their lifetime mortgages, even over 50s life plans and things like that. So yeah, exciting times ahead. But thank you so much for joining us today, Rachel. It's been a really great session. And as always, we really look forward to seeing what positive outcomes the rest of 2024 brings, and looking forward to hear what More to Life have to bring to the table. Hopefully very soon we get to hear more about that. But yes, thank you very much.
Thank you very much, Victoria. It's been a pleasure.